According to the latest inflation report, consumer prices rose by 4% in the year through May. This is the slowest pace in over 2 years, and comes as a relief to consumers. The report offers encouraging news to the Federal Reserve, as a key price index slowed more than expected in May. This could give policymakers comfort in pausing interest rate increases at their meeting this week. The Consumer Price Index, CPI, increase of 4% in the year through May, was slightly lower than the 4.1% expected by economists, and marks a significant slowdown from the 4.9% increase seen in April. Although this rate is still higher than pre-pandemic levels, it is down sharply from its peak of around 9% last summer. These latest figures provide evidence that the Federal Reserve's efforts to control rapid price increases are starting to take effect. The central bank has been raising interest rates since March 2022. To make borrowing more expensive and dampen consumer demand, which is intended to cool down inflation. With a streak of 10 consecutive rate increases, bringing rates just above 5%, many officials have indicated the possibility of a pause to assess the impact of these adjustments. Investors had already been speculating that the Fed would keep rates unchanged at the current meeting, and Tuesday's inflation figures further support this expectation. The chances of a rate hike have diminished significantly. However, there is still a belief among investors that the Fed may resume rate increases in July. When excluding food and fuel prices, the core measure of prices increased by 5.3% in May, compared to the previous year, slightly higher than expected. However, it was lower than the 5.5% increase seen in the previous month. While there are indications that inflation may persist, the overall data suggests that the rate of inflation is slowing down significantly. A cooling economy and a gradually weakening job market could further contribute to reducing inflation in the coming months, giving central bankers confidence that they have raised borrowing costs sufficiently to bring prices back under control.